The day hype shattered reality. Imagine this. The CEO of the planet's most hyped tech company just admitted that their $200 a month subscription bleeds money on every user. Not a tiny loss, not break even with hope for growth, straight up loss. And Wall Street? They slapped a $500 billion valuation on it. Welcome to the AI bubble, a journey from cool chatbot to a $7 trillion gamble in just 2 years, and why the people signing the checks might soon get the harshest wake-up call since 2008. November 30th, 2022. A normal Wednesday, cold brew on the desk, engineers typing away. Then OpenAI drops ChatGPT. Within 48 hours, the internet went wild. People were using it to draft breakup texts, debug code, explain black holes, and even spin bedtime stories. Kids were like, "Dad, this AI knows everything. It just explained quantum entanglement using Minecraft." Minecraft? Yeah, that too. 1 million users in 5 days, 100 million in 2 months. Instagram, 2.5 years. Facebook, 4.5 years. ChatGPT did it in 60 days. And Silicon Valley? Total panic. Inside Google HQ, executives were losing it. "We invented this kek. The transformer model, that's us. Our research paper is literally cited. So why is everyone using ChatGPT instead of Google AI?" Answer: Google was too scared to release it. Lawsuits, bad press, rogue outputs, they froze. OpenAI, no fear, they shipped first. And in tech, first mover advantage is everything. Microsoft threw $10 billion at OpenAI within weeks, with $3 billion more waiting. Google panicked and launched Bard, which hallucinated immediately in its first demo. Amazon funneled billions into Anthropic. Even random dog-walking apps pitching AI optimization got $50 million in funding. By mid-2023, if your pitch deck mentioned neural networks or large language models, investors were basically giving you money for free. Companies with no product, zero revenue, just a team and a Google Doc were raising $100 million rounds. The bubble produced bizarre tech marvels: AI toothbrushes, AI recipe generators, AI dating coaches. One startup even raised $30 million to build an AI that summarizes other AI outputs. Peak absurdity. Then came the GPU shortage. Those tiny computer chips, looking harmless, suddenly became more valuable than gold. Nvidia skyrocketed, their CEO, Jensen Huang, rocking leather jackets like the Mick Jagger of semiconductors. Renting a single top-tier GPU cost around $3 an hour. Sounds cheap? Startups need hundreds. A small AI model might rent 500 chips, costing $36,000 a day, over $1.1 million a month. Yet companies hoarded GPUs like doomsday preppers stockpile beans. Nvidia couldn't make them fast enough. Waitlists hit 12 months, and black markets emerged. People were smuggling GPUs and money across borders. By 2024, everything was AI-powered. Toasters burned bread 10% better, calendar apps suggested meetings using algorithms, grocery self-checkouts learned from cameras. Party mode, champagne flowing, checks clearing. Then someone whispered the obvious question: how much is this costing? The math doesn't add up. January 2025, Sam Altman, the face of the AI revolution, drops a tweet that spikes investor blood pressure. AI Pro loses money per subscriber. The more popular it gets, the deeper the losses. ChatGPT Plus initially tested $20 versus $42. Pick the one people complained about least. No market research, no cost analysis, just vibes. OpenAI's 2024 numbers: revenue $3.7 billion, losses $5 billion. Not close, way more lost than earned. Here's the kicker: the AI industry will need $6.7 trillion in infrastructure by 2030, $5.2 trillion for GPUs, accelerators, cooling, power upgrades, data centers, $1.5 trillion for traditional cloud. The top 4 tech giants alone will spend $350 billion in 2025 alone. To justify this, AI must generate $2 trillion annual revenue by 2030. Current total, $200 billion. That's a 10x gap. Sam's projection, $20 billion in 2025, $100 billion by 2029. Necessary growth. Reality, a $115 billion cash burn by 2029. Profit, maybe 2029 to 2031. And if revenue doesn't hit $100 billion, raise more money. From who? Microsoft? Saudi Arabia? A very optimistic pension fund? Since 2021, private investors funneled hundreds of billions of dollars into AI startups. Most went to just 10 companies, whose combined valuations swelled close to $1 trillion. Everyone betting they'll be the next Google. Then the cracks appeared. ChatGPT hallucinated, invented sources, fake research papers, imaginary legal cases. Google's AI told users to put glue on pizza to stick cheese. Lawsuits followed. Artists, writers, musicians, journalists, all asking if their copyrighted work trained these AIs. Answer? Yes, we scraped publicly available data. Sounds illegal? Yeah. By mid-2024, the vibe shifted from euphoria to doubt. The hype was loud, the math ugly. This bubble isn't like 1999. It's funded by giants with real money. Microsoft, Google, Meta, they aren't investing because it's profitable. They invest because they fear being left behind. Miss the AI revolution? You become the next BlackBerry. Big tech is like poker players with unlimited chips. If one folds, another wins. Everyone keeps raising the stakes. So when will it pop? Real-world events. Funding disappears, a catastrophic failure, or a scandal. Until then, the bubble floats. We're not at the explosion, we're at the tightening, the inhale before the scream, the tension before the snap, the episode right before the season finale.